Welcome to the Property Couch, where each week you get to listen to two of Australia's leading property experts. Bryce Holdaway, co-host of Location Australia on Foxtel's Lifestyle Channel, and Ben Kingsley, chair of Property Investors Council of Australia and the 2014 and 2015 Property Investment Advisors of the Year.
All right, folks, welcome to the Property Couch. Hello Melbourne. How is everyone? How cool is this, Ben?
It's very cool, Bryce. I need to make sure I lift this microphone up when I talk as well.
It's very, very cool. It's quite surreal for us because it really started out with a conversation that I said to Ben, look, as Rachel said, that Rachel was episode 130, by the way. Has anyone heard Rachel on the podcast? Hands up. Yep, wonderful. So Ben and I had another conversation in the hallway of our business at the time. We were in a different office to what we are in now, and we just looked at each other and said, another one has been stung. And so we kind of thought, what is it that we can do about this? And hence the Property Couch was born. We're in a little 3x3 office with Stiggy's little Samsung. We push record, and here we are tonight, Ben. Welcome.
It's amazing. So thank you very much for coming out on what is not necessarily the world's nicest Melbourne night. So we really appreciate you being here, and hopefully we can deliver the gold, which is what you're here to hear, not us.
What do you think of the property stools? Hey?
No couch.
Would have been more appropriate for the Property Couch. We tried, but couldn't get it here. But again, it's a real joy and privilege. We're going to spend the next couple of hours with you tonight. We reckon we've got some really cool stuff to share with you. There will be opportunities for you to ask questions throughout the night, and we certainly hope that they come through thick and fast, don't we, Ben? But I don't know if anyone's familiar with Tony Robbins' 6 core needs, but it's something that I think... who's heard today's podcast that went out at 3 o'clock today with Jamin? Yeah. So he hinted about the 6 core needs, but there's certainty, variety, significance, love and connection, growth and contribution, and ultimately, at some point in time, we are looking to meet those needs. And the Property Couch serves that for Ben and I, because the certainty that we get is the fact that we can meet once a week. It's our favourite time of the week. You'd think that we work in the same building, that we talk to each other all week, but we often don't. So it's that one time we get to close the door, soundproof room, have a bit of a chat. The variety is that we get to interview. We purposely put an extra seat on the couch, Ben, for the best experts in Australia, and they regularly get to sit there with us, which is a real joy and privilege for us to have those conversations, but be able to share those with you also. The significance comes from the fact that we want to create a positive influence in our community. We want to create a positive influence in the property investment industry, because there was a couple of people that had came up and shared with me at the top of the stairs here, where because of the information that they got on the podcast, they were able to make a really great decision on the property that they purchased, Ben. So that provides us with some significance, because we are making a difference, which is really great.
It's absolutely life-changing in terms of getting that message right and getting that execution right. So, there's no agenda with what we talk about. It's what we believe. It's based hopefully in numbers and what we're trying to deliver, and that's what tonight's going to be about, in terms of making sure that we can answer as many questions as you've got for us, and then also do our data dive, because I've got a big screen.
He's got a big screen, and
he's
excited.
I have a massive screen. That's great.
Any other Collingwood supporters in the room?
Yes.
Wow,
Go Pies.
That's disappointing. Here's one. Is there any Fremantle supporters in the room?
Yeah, that'd be about right. Yep.
Did you hear that noise? That's what it's like talking about Fremantle in Melbourne. Yeah, it's just cue the crickets. Hey, the last three connection, we get to connect with people like you on nights like tonight. For us, the growth part comes from the fact that we test each other each and every week to look for more material to provide to the community, with the ultimate goal to empower you to make better decisions, and hopefully create a self-funded retirement, which is our goal. And then the contribution, Ben, is the giving back, as we saw there. So in that little piece. So how exciting, Ben. Mate,
I think that's a good segue to your Mindset Minute.
It is a segue to my Mindset Minute. And for those people in the room, they obviously just saw what I'm going to talk about for the Mindset Minute. But for the people that are listening at home, Ben, my Mindset Minute is from Arnold Schwarzenegger. His 5 rules for success. 1, find your vision and follow it. 2 was never ever think small. Number 3, ignore the naysayers. Number 4 was work your butt off, Ben. I think he said a different word to that. And number 5, don't just take, give back. And really that's I think there's application to all the property investors in the room as well. I think there's some principles that we can put into play there, Ben.
I agree. I think what in some of the questions that we got for tonight, that you sent through, thank you too for the amount of questions we got. We've got a lot of material to work with, and what we saw in a lot of those questions, and we're going to try and address that tonight, is the uncertainty in the market, and that's really what tonight is trying to also focus in on, to sort of, I suppose, lift your eyes around not just sort of in the here and now, but just see some of the results that we've seen, and just get some confidence back in regards to your investing, because that is always what goes first. When sentiment and confidence goes, you start questioning yourself and you start thinking short term, not thinking long term. So hopefully we can address a couple of those concerns tonight.
Exactly. Who in the room is a property investor right now? Just by a show of hands, nice and high. Keep them up if you are a multiple property investor.
Oh, okay. Wow. Good stuff.
Wonderful. And whilst we're practicing, who wants to hear more of the stig on the property couch? Hey?
Oh, it's unanimous.
It's unanimous. Where is the stig? Is she hiding from us?
She will be hiding.
That won't. There she is. I can see you, Ivis. So we have the privilege. It's really a trio. The property couch. Ben and I obviously the face of the couch, but Stiggy makes it happen. We were running around before. Ben and I were really relaxed, and Ivis was dripping with sweat and making this all happen. So she's a terrific asset to us, and she really is a huge part of the show. Now we're going to start with some of the questions that you guys gave us, as Ben mentioned, and then we're going to throw it over to the floor. We're going to give you a chance to ask some questions, and then a bit later on, we'll have a few extra things that we can share with you. Is that okay?
Sound like a plan?
How's everyone feeling? Good. All right. Hey, as Ben said, most of the theme for tonight is around a changing marketplace, and that's where a lot of the questions were directed to us. So there's a theme. We've got some around finance. We've got some around beginner questions, Ben. As per usual, we'll probably go off on tangents, which is really part of what we do. But the first one, I'm going to just riff off a few of the questions that some people have asked us, and then Ben and I will give some contributions to you guys. Feel free to ask any questions if you feel appropriate. But Tim asked us, what's the biggest challenge that we're having? Tim said a fear of a severe downturn. Is there anyone else who feels that way?
Let's be honest. We all should have a fear of a severe downturn. I mean, ultimately, that's it's a big investment we're about to make. So there should be some concern about that. So it's nice that Tim's front-footed it, because obviously when we see our fears in front of us, we're going to be able to hopefully overcome those fears. So look, a severe downturn, an economic tsunami, that's going to affect all of us. So, that is, a slim possibility. So let's just acknowledge it for what it is. But ultimately, in terms of what we're looking at is we go through cycles, and we'll be spending more time thinking about that as well. Absolutely.
Alan wrote in and said, what about the impending federal election, specifically around CGT, capital gains tax and negative gearing? So that was a good one. Simon wrote in, I want to buy a home to live in, likely in Melbourne. Should I be waiting to buy it given the slowdown drop in the market right now? If so, how long should I wait for? Should I buy an investment property instead? And in brackets says, I won't be fussy where the property is located. So that's from Simon. We had one here from Dave. I currently am having some real hesitations in regards to the current Melbourne market. I know I shouldn't be listening to the headlines, but I'm getting it from many other sources that work in the property space. Also, the market is slowing. My question is around timing. Do you think I'm best to hold off a bit before purchasing? This will be a buy and hold. So that's a good one from Dave. These are all the economy-related ones, so we'll get them off and then Ben and I'll riff on them. But the Heron Todd White property clock seems to indicate that Melbourne is going to be a declining market in the not-so-near future. How long does this normally last? And do you see buying opportunities in Melbourne while it is a declining market? From Mike. And the last one around economy is from Leah. The media is talking about house prices reducing over the next year. Should I wait until later to purchase my investment property to get a good price, or buy now as I'm ready? Ben.
So lots of commentary around timing. That's a big theme of the data dive that we're going to do later. I want to start with the first one around GST and negative gearing. So the reality is we've got one large political party who's looking to introduce changes in that area. And if you're new to the podcast, you just need to circle back to those episodes that we talk about around our concerns of how that's going to impact the market. Now, we do know that the federal election needs to be before, I think it's around before May. So the reality is if you want to get a negatively geared property, don't leave it to the last minute, because if they do get in, then ultimately, remember, it's going to be grandfathered, so there's going to be no clawback on that if you are looking to take advantage of that principle. Now, for me, the fight just begins, as the chair of PICA. That's just the start. We've reversed it once before, in 87, so I suspect, the fight begins there. But if you are looking to, to look at some of the opportunities in the marketplace for long-term growth properties, that's something to consider. If you are talking about when you should start, we've got obviously a strong view that you should always start when you are ready to do so. So that's an interesting one for me. We know if the Liberals get in, well, it's business as usual in terms of what that looks like. So my biggest concern around the changes to negative gearing is basically we've got a second-hand product market. And when we see second-hand product market, what does that do for the resale value of those assets? So that's really concerning. We saw some research come out recently about, some sort of significant declines that we might see in some markets, and I support that. I think every market's going to be different. My strong views are that people will start land banking rows of houses closer in and demolish those houses and start to build townhouses and units. And I don't know whether that's good for us in terms of having that choice of style of accommodation closer into our cities. But that's an incentive, because remember, I can get negative gearing on new properties. I just can't get it on existing. So that's a concern for me.
The other question that I often ask people when they have these sorts of questions is, have you ever met anyone who's bought Melbourne? Have you ever met anyone who's bought Sydney? Because that's what often happens. And we're of the view that generalised commentary helps absolutely no one, because no one's buying Melbourne. In fact, no one's buying Yarraville. No one's buying Bentley. No one's buying Richmond. Someone is buying a property in a street in a localised part of a suburb. And I think that's always something that we need to remember. So I think when you're buying in a market where the sentiment or the headline sentiment is like what we've got in Melbourne, you've got to be very specific about what you're buying. And hopefully those people who have done a lap of the property couch would know that it really comes down to human interest, human behaviour and economic activity, right? So if you're looking at a property that well, first of all, suburb, what percent of the suburb or the location does the heavy lifting? 80%.
Thank you. First tick.
So if the location does 80% of the heavy lifting, we've got to be really clear about what suburb in Melbourne we're looking to buy in, because there are parts of Melbourne that are a little bit overpriced. There are segments of Melbourne that you would actually want to touch in terms of a price point, but there's certainly segments of the Melbourne marketplace that are still very strong. To give you an example on the ground, I've got a team of buyers agents. There's 11 of us here based in Melbourne. And we missed 16 properties in June. 16. We took a swing and we missed at 16 properties. So we didn't buy a suburb. I can assure you we didn't buy Melbourne. We had a crack at a property in a localised street in a localised neighbourhood, and we missed 16 times. We're professional buyers. We're not seduced by buyer's guides. We're not seduced by what the agent has to say. We've got a very firm view on what we think is value. We've got a very firm view on what we think it's going to take to buy. We're not there. We don't need the practice of turning up at auction. We don't need the practice of negotiating to miss. We're going to buy. And we missed 16 times. The month before, we missed 14 times. Now, these are 2 months where sentiment would suggest that the market is down. If you have a look at the auction clearance rate, it's heading towards 60%. So those headline sort of commentaries would suggest, why are we even having a swing at all? But I can assure you that it really comes down to the fact that my team knows how to buy investment-grade properties instead of investment stock. And the investment-grade properties have got owner-occupier appeal. So not only are the investors interested in those properties, we've also got the large majority of the market, which is the owner-occupiers, interested in those properties, and we miss them. So I think it's important whenever you are faced with this question, whenever someone talks to you at the lunchroom or the water cooler about what you think about property, the fundamentals of property from our perspective is to buy the right property, correctly finance it and hold it for the long term. So if you actually have an opportunity where you've got all of those things in place and you find the right suburb and you find the right property, hey Stiggy, hey? I'm under enormous...
For those who are listening now, Stig's just walked on stage in front of 400 people and she's thinking we're not going to acknowledge her? I mean, come on. You want to be in the background.
I asked her to get some of those photos and she put me under strict instructions. She tried to wear clothing to blend in as well. make sure she was camouflaged. But yeah, she's a terrific part of what we do. She makes us look good, doesn't she, Ben?
And so to round out that point, it's markets within markets, right? That's what we've always talked about. So there's always going to be buying opportunities, and we should lift our eyes in terms of borderless investing, and we've said that before. So, coming back to the Heron Todd White point around the property clock, the market is coming back to equilibrium. And that's an important point. Jeremy Shepherd, who's the king of capital growth, is not necessarily concerned about a large correction, but he's just basically saying the market's coming back to equilibrium. What we've got to watch is in some suburbs, they have overcooked themselves. There was definitely, too much over-exuberance in terms of what people were paying. So you're going to see that in any cycle, you're going to see them come off their peaks, but you'll also see in terms of long-term responses to that there's obviously going to be opportunities down the track as well.
The biggest risk that we have to our property market here in Melbourne is if we stop immigration, because ultimately there's more people coming here than we have accommodation. So if you're in my hometown of Perth, or if you're in a regional area, or you're in something, a town that doesn't have the benefit of being a big metropolis like Melbourne and Sydney, is where you've got these multinationals offering six-figure incomes. We're part of the world stage. We're world cities. If you're in a city like that, well, then you've obviously got to read the play. But the question around Melbourne is, should I wait for the market to drop? Well, you realistically need to think about what that means. It means that there's going to be no competition for properties. There's a property that goes up for sale. No one's interested in it. The buyer has all the power. And if you have a look in investment grade suburbs in Melbourne, that just isn't happening. There are generally, if the property's right in the right suburb, that you're not turning up to auction where there's no one looking to bid, even despite the fact that the auction clearance rate is dropping, because that's an average that doesn't take into account the individual within the system, Ben.
So if Arnie Schwarzer Schnitzel, if that was his name, he talked about the naysayers. You've got to expect it. You're gonna, there's going to be people at barbecues who are going to say, "What did you do that for? Oh, the whole world's going to cave," and blah blah blah. So I always say expect the noise, because it sells papers and it does good for the media in terms of that. So that's obviously a challenge that we've got to overcome, and having obviously the opportunity to show you some data today is going to hopefully put some minds at ease as well for those who are here, and that's going to be available also via link as well for those who can't make it today.
Does anyone have any specific questions about the Melbourne marketplace that they would like to ask at this stage? And I know it's always difficult to be the first one who puts their hand up, but I'm sure someone's thinking, hey, I might have a question. Does that apply to anyone here?
We've got a couple of microphone runners on each side. It's a soundproof room, so if you just want to yell your question out, because it might take us 15 minutes to get the mic to the centre. Yeah, we've got one up the back here. There. Thank you. Talk amongst yourself whilst we wait for the mic to get to it.
Hi, it's just a really simple question. You mentioned overcooked markets right now. I was wondering if you can give any insight into which particular suburbs in Melbourne you think might be overcooking.
Overcooked. Yeah. Overcooked. So the evidence which is suggesting that it's mainly the higher end suburbs have come off their peaks, and we are still seeing in the latter stages of this cycle the outer city areas still performing pretty well. So in the affordability belt, we're seeing those suburbs outperform both the middle and inner city areas over that short period of time. So where we're seeing an appetite and some challenges is in price points for 2-bedroom houses around the $1 million mark, and we're also seeing some challenges in freestanding houses in that sort of 2 million mark. Now that's not a marketplace that we spend a lot of our time with a lot of our investors in regards to buying now, but that obviously represents some buying opportunities as we watch the data in terms of when they turn. And again, for all of those people who are listening who aren't here, this is where I'm going to keep referring back to the data that I'm about to show, because we are going to do a dive into that data and look at short, medium, long and super long-term performances of a couple of markets around Melbourne. And then later on, we're also going to have a look at, within a market, investment grade versus investment stock. So for those of you who are listening at home or on audio, you're going to have to click on the link and come and get that info, because it's where we can tell the story. It's very hard to tell the story via audio in this case.
Yeah, that's why you're excited about a big screen. But I think one of the missions that Ben and I have on the Property Couch is to empower people when they're faced with a question to use the frameworks that we talk about. And it's largely to look for the suburbs that you need to be focusing on is to understand where the growth in income is likely to be. So by that we mean borrowing power largely dictates property prices, because you could have people with desire to spend more, but if they typically can't borrow enough money to buy the asset, they typically can't. So you need to be looking for suburbs that have a mix of people that are living there that are in control of their income. And by that I mean they're not waiting for CPI increase in wages. They could be an accountant, they could be a dentist, they could be a small business owner, they could be a sales executive, they could be someone who is in control of their income, which means that next year, if they earn more money, typically speaking, all things being equal, notwithstanding there's a few challenges around credit right now, that they can borrow more money, pay more, and then when you get two or more people interested in those properties, it has the effect of increasing the value, or just based on simple supply and demand.
Yeah, so make no mistake, we're not automatically saying, as a caveatual statement, that you should always just invest for the long term, okay, and stay in a property that's underperforming or in a marketplace that's underperforming. We're going to marry the two tonight in our data dive around timing the market and time in the market, because with big data, new algorithms, and our location score product, we were able to show you in terms of where those timings live, of where that market's more than likely going to start to see some further capital growth. But we were also saying don't necessarily jump out of markets if you feel that it's going to have some type of correction. There is a balance in terms of looking at those fundamentals. This is what we talk about: human interest, human behaviour, and the underlying land value, which we're going to explore more in terms of trying to get that comprehension right around long-term performance. So, the power of those two multiplies your outcome. Time in the market and timing, i.e. buying in the right market in the first instance, is also going to be highly valuable in terms of your overall investment strategy.
So who else has got a question that they might want to ask at this point around the Melbourne market or the Australian property market in general? This is the People's Podcast. There we go.
There, thank you, Brian. Pass it along, pass the parcel. There we go.
Thank you. Just in reference to the question you just answered, you mentioned higher end and middle suburbs perhaps at their peak, and some of the lower end suburbs still performing well. Do you foresee that being the same story for the next foreseeable year or so, as we're talking about this slowing market? Do you see that same story continuing, or a change in the near future?
So the data's going to tell us that story, and I suspect a general statement is not going to do it justice, meaning that there's still going to be some markets that still hit their price point in terms of affordability. Because if we look at the income data in those particular areas, we will still see a price point threshold. So it's going to come down to those different markets in terms of whether they've reached those levels. But what we have seen, and what you will see in the data shortly, is this outcome around that performance. So we'll continually keep monitoring demand and supply in those areas, and that'll tell us the story. So we don't want to guess, but we will know pretty clearly in terms of, as it moves from the higher score down to a more moderate score, that's going to tell us that story around that. And I hope to answer more of that question when we get into the data.
Who else has got a question for us?
I think one's coming up over here. Brian, if you can come down. We'll go with the gentleman at the back.
Sorry, just on my last question, just to be very specific. So we had an explosive boom in the Melbourne market that seemed to center around inner southwest Melbourne. So we had Williamstown, Newport, Altona, South Kingsville, extended to Altona North, partly to Altona Meadows, but not really. Became an investment opportunity. So these hotbeds, I suppose, like Williamstown and Newport, seem to be overheated at the moment. You compare them to some of the more prominent southeastern suburbs, you can get much less attractive properties in Williamstown for a similar price point that you can get in a prominent southeastern suburb. So you spend about $1.5 to $2 million in Williamstown, and you get to 4-bedroom, 4-bed, 2-bath house that's sitting on about, 350 to 450 squares. And I'm just wondering, it seems a bit overheated. You're getting townhouses there in Newport on the fringe between Williamstown and Newport. Beautiful townhouses, well built with great furnishings, selling for 1.2 with very little space. I'm just wondering, is Williamstown being kind of a peninsula, kind of an area that cannot grow any further, that has a limited amount of growth potential in terms of land? Is that something you think will maintain its value, given the recent boom, or are we going to be seeing more growth in the outer suburbs? Of course, I think we will with migration and everything else. But the biggest boom and the biggest push up in price was in Altona, Williamstown, and Newport. In those areas specifically, do you think that we're going to see any sort of change moving forward?
Yeah, look, I think that the reason why those suburbs did so well in the last little part of the cycle was the fact that the price discrepancy between the location of Yarraville and Seddon compared to the same distance on the other side of the city was, double plus 15%. So there was opportunity. You saw some gentrification. You followed the train line. I can get a single fronter in Yarraville that was at the time $6 to $7.50. I can put my own extension on the back, and I can be 3 or 4 clicks into the city on the train, whilst having really great coffee in the Yarraville or Seddon village. So that's where the opportunity came, because you could see that price discrepancy. But what happens is, as that starts to rise again, people then make the same decision. They go, well, do I want to be on the other side of the city because the price disparity is not so great anymore, and people will tend to gravitate to the leafy east, all things being equal. So I think that will be a continual fluctuation, and you see an opportunity and you take it. But for us as a team, we were buying in that inner western pocket for some time, and we haven't been there prominently for a while, so we move around and we're looking for the opportunities. And for us, given that we've got a city that's so big, I'm a small town boy from Perth, whereas you come here and there's just double, triple the population. It's really important around congestion. So as part of what we do as a team is we're just following the train lines all around Melbourne and seeing where price arbitrage exists. So you're right. Some of those inner western markets are really hot, but we've had clients in there that did buy in at 6 and 7s and 8s, whereas now it costs you $1 million. So I do see that the pendulum will swing back if that price disparity gets too small. But again, over time, throughout the cycle, that will deepen. People will look for that again, and they'll move into those locations. So for us, it's around chasing train lines, studying the demographics to see where people are in control of their income, overlaying the filters we talk about in terms of the suburb and then the property. And but everything's, there's nothing fixed. We're not a one-trick pony. We'll move around. Where as a team we're buying in Brisbane, we've bought in Adelaide. We're buying little gentrification houses in Adelaide, in the inner west of Adelaide, where we bought one. It was a little single-fronted period home. On 300 square metres, essentially one suburb away from Adelaide. We paid $501,000 for it. One of the podcast listeners will probably hear that. Now you can't get anywhere near that. So that little part of Adelaide on the west was gentrifying too, because it was the last one left. There's no gentrification in Brisbane because it's the river city, so they don't have that traditional western suburb stigma on the east coast. I'm from Perth. The western suburbs are the best, but they have the river run through. So some of the best suburbs in Brisbane are actually in the western suburbs. So it's Adelaide had this last bastion of gentrification. Melbourne over the last 5 years have had that gentrification pocket. We've moved around. So I think we'll go wherever the opportunity is, but being mindful of the fact that when given a choice, people will generally chase the leafy fertile crescent of Melbourne if the price disparity isn't big.
Thank you.
And I think if we're looking at percentages, what we're going to be talking about is we're going to show you that the outer suburbs have outperformed. Then we're going to wind the clock back and basically look at what's happened in the last decade, 2 decades, 3 decades, 4 decades in terms of the data dive we're going to do. And that hopefully will give you a little bit of clarity around that. Because what underpins the land value is, the property value is the land value. So the question is Williamstown, is Middle Park, is Caulfield, is Parkdale, are all these areas going to sustain their land value? And what our observations are is that the value of the land central is the core that pushes out. So when the income story is from the centre, effectively what happens is that land value pushes out over time. And that's that affordability story. But in some cases, you're absolutely, from a percentage point of view, going to get a better return in some of the outer suburbs for a shorter period of time. But as you look over the longer period, you're going to see some of that debate around what that property price looks like and what the underlying land value is in those particular areas. And that's consistent with what happens in big metropolises around the world, Western metropolises that are. And then you've got to overlay the human interest and human behaviour stuff. And that's the fascinating stuff around it, right? Because what we saw in Williamstown, Yarraville and those areas is the period homes, the post-wars, the weatherboards, those types of things, the villages, that lifestyle element, and then the status increases because it's gentrified, and off we go. Okay, so but we've already got that in the Leafy East, but we also see the Leafy East over time also doing very, very well. So it's a fascinating question, and one that the data will tell us a little bit more insight.
Yeah, so my question is sort of related to what you guys were speaking about. In Melbourne, there's obviously being a young investor, it's not easy to get into the inner Melbourne pockets, and I can just say that obviously someone of my age is looking sort of in the middle to outer ring, just getting out, and that's where I've done so in the recent past. I just want to you sort of touch base on that being in Melbourne, you get the amenities that you wouldn't necessarily get in an outer suburb like really far out. If you look in the western side, the Wyndham Vales, those sort of areas, or in the north.
Yeah, we're going out there in the data, so this will be really relevant as we talk through that story.
Or areas in the north like Donnybrook or Calcalo, or in the west, the east, you got the Clydes and whatnot. So short term, I've seen a lot of growth there in capital terms, but what's your thought on that, given the fact that, especially long term, there's not going to be those amenities there that you have in the inner suburbs? I was just curious to know what your thoughts are long term.
Look, I've got a question for you all, and also those people who are listening audio-wise. If you were to close your eyes and you think about everything you want in a property and then everything you want in your community, in your area, where are you most spoilt for choice? You're most spoilt for choice closer in, all right? And that is, that's one of my lessons in the data dive is because we are spoilt for choice and because the land is fully utilised, we talk about it in terms of practicality test and livability and status and all those things, but the ultimate choice is there, and the competition on the land is also what drives that land value in the bigger cities. So that's why we have, really the land value from the in pushing out. But people will push demand in the short to medium term. So one of the great debates that Jeremy and I have, because I love the fact that Jeremy's, a really strong thinker in this space, is that, no one's convinced me that an area 25, 30, 40 kilometres from a central business district will see the land value out there be more expensive than the land value closer in. Now, if that's underpinning everything, then normally what you would have, so if you do get a compression of land value and property prices in, will that flow through exactly like the ripple effect where the values go more expensive in and flow out? And that's the $1 million question. So we've got to look at technology. We've got to look at human interest and human behaviour. Are we all going to be in 100, 200 years teleported to the places that we won't have congestion? Will self-driverless cars mean that we're happy to sit in a car because we're productive and it means we're going to live out wide? I don't know. I still think we're social creatures. I still think the fact that we're ultimately spoilt for choice, for culture, for everything, for sport, all of that centralises. So, someone would have to convince me that we're going to see a human change in behaviour that's going to say we all want to have a massive green change really quickly. And I don't think that's going to happen in my lifetime. And so when we do take long-term views, 40, 50 years, because ultimately, when we're spending, if I put my investor hat on and I'm playing with other people's money, I need to take that long-term view. I definitely want to get short-term growth, but I also need to see over the horizon. And I need to understand whether I've got clients who want to be, traders and move, considering the cost of getting in and getting out, versus, basically that long-term buy hold. And that's a really fascinating question.
Who else has got one?
Go for it and we'll just repeat it.
Just on what you were talking about then, do you think, say, similar to Sydney, how they've got, say, Parramatta as a second CBD, do you think something like that could happen in Melbourne because it has sort of sprawled so far?
The question was regards to in Sydney, you've got other CBDs like Parramatta, and do we see that would happen here in Melbourne? I think so. I think there's already extra nodes that the government is placing time, energy and effort on to expand, because Sydney's got more population than us, but it won't be long before Melbourne overtakes them. So the model that they have will be something that we will adopt. So it's something that we're mindful of. And, Sunshine, for example. I don't know if anyone lives in Sunshine or anyone is familiar with Sunshine of late, but it didn't enjoy the greatest of reputation. It's now over $1 million to buy a decent house in Sunshine, and who would have thought? But if you're driving around Matthew Hills estate in Sunshine, you could be anywhere in the leafy east. So those areas, and if you haven't been on the train line out to the west lately, it's well worth it, because they've got the best train stations in Melbourne. They've really gentrified. So there's already planning in place for those extra nodes in preparation for the population that's going to be coming here.
And if I could add to that, if I look at the competition for that land, I'm not only just looking for that competition of land for residential use. I'm looking at that competition of land for high-rise, for hotels, for supermarkets, for mixed use, for all those types of things. So, we obviously recently opened in Sydney. We chose to set up our offices in the Sydney CBD, and when we were obviously pricing the cost for our office sites, it was obviously very expensive in the city. It was less expensive in North Sydney, and it got even cheaper in Parramatta. And so I do believe that there will be this ripple effect, and you will see a lot of movement of people into those precincts, and there will be people who want the convenience around that. But I still think you come from one central core. And I think that's consistent with New York. I think that's consistent with London, even though the financial district is the one that brings in some of the bigger incomes. The 500 years of houses in certain marketplaces in those areas, it's pretty consistent that the land value that's underpinning that, because of the competition of use, comes from the centre and moves out. So, we'll see that in the data as well as we have a look at it.
Thank you. Just a quick one here from Samuel. It's a beginner question. Buying the first property, not having the experience to know how to best research and select property. Additionally, not having the financial muscle to utilise a buyer's agent at the stage where you need them the most. That's interesting because, sure, a buyer's agent does cost money, but you can get some free advice, because largely building a portfolio is about buying the right property, financing it correctly and holding it for the long term. So you can talk and get some advice from an investment savvy mortgage broker, and they will teach you how to structure correctly, how to put buffers in place, so that you can cash flow the property. So that's a start. Slight shameless plug, but we've got Location Score, which is a very affordable way to find out suburbs where demand exceeds supply, because the enemy of capital growth is where supply exceeds demand. So that very affordably can at least get you looking into the right suburbs and give you this wonderful safety net to be able to make sure you're not buying in the wrong suburb. And then, of course, the information. I mean, when I bought my first property, Ben, it was back in 1999. It was in a suburb in Perth called Victoria Park. It was in a block of over 100 apartments, Ben. It was 3 bedrooms. There was a lift. There was a pool. There was a caretaker. There was everything that we talk about that you shouldn't have. And I was paying body corporates for a lift that my block didn't even use. But for me, getting around other property investors was actually not that easy. There was a couple of books around, and I stumbled across a group that got together and they would chat about it, and I thought I'd found nirvana. But now there's so many podcasts. Clearly, we love the fact that you love ours, but to be able to make an informed decision, if you listen to the podcast and you listen to the principles and you apply those principles, you won't make a mistake. The challenge is that people listen to our podcast. I said this when we were in Sydney. They listen to our podcast and then come and ask us, I've got this off the plan property, do you think it's a good one? And it's like, wow, really? I mean, one of the questions here, Ben, was, if I can get to it very quickly, was why is everyone so afraid of off the plan? Well, because supply is the enemy of capital growth, and you don't want to put yourself in a position where they can oversupply. So, Ben, you might want to share, but there are some ways to make sure that you essentially the podcast is the what. We teach you everything that you need to know, and some people choose to use people like us to help them, with the how. But really, the what is available on 180 episodes, isn't it, Ben?
Yeah, it is, and in throwing it out there, when I first started, I just grabbed every book, I grabbed every magazine I could get my hand on. I spent lots of time learning and just self-educating, and so the advent of the internet has allowed that to happen, and you do your 10,000 hours and you keep learning and you keep your mind open. So I know that in the work that we've done with Jeremy Shepherd and also our research department, I'm even there's some stuff I'm taking on board and learning, things that probably I would have challenged in terms of the data that I looked at as also being retrospectively debated, and that's healthy. So if you can get yourself around people who are like-minded and you want to share that information, I would also say join Picker as a shameless plug, all $5 of it, or $20, and we're going to start doing some meetups around Australia, and that is like-minded people who are going to share some of their knowledge, because that's also what Picker's about. It's not just also about lobbying on behalf of property investors. It's also going to be a means by which you can get educated. Your Investment Property Magazine, Smart Property Investment, they've got data on their site. There's a lot of different ways in which you can continue your education if you want to make it free for yourself.
But the best place to go to, folks, is you just go to realestate.com or Domain, go look on the sold tab, find out what the value of the properties are. It's very easy to do some of this research. It's actually remarkably easy to do it. Clearly, we can see. I always think that I used to go to the in Perth they called it the Royal Show, and I'd be sitting on the side and watching the farmers with their prize cows, and someone would go, "Can you tell the difference between the two?" And I'm like, "Nah, they're both black and white. What's the difference?" But someone who knows what they're looking at can see the difference just by looking at it. And I think that's probably what you get when you have some experience. And, I know straight away if a property's investment grade without really having to dive into it. So I guess that comes with a bit of time. But ultimately, there's enough information out there for you to make the right decision. Again, if you apply the frameworks that we have on the podcast, Ben.
Fantastic. We've got around 10 minutes if we need to. Question down the front here. Thanks, David. If you can get a mic into... Oh, David and David. Okay, here we go.
We talk a lot about how to find property, how to go towards our goals. How do we balance socially responsible investors with getting to our goals and making money? Because we always seem to talk about how we make it, but how can we be more socially responsible about how we do this as well?
So my question to you is, what is for you socially responsible? Because I think it's probably going to be different for everyone. I think APRA and that are going to ultimately make that determination for us in terms of how much they're prepared to lend to us. I think that gone are the days where you're going to see mum and dad investors owning 10, 15, 20, 30 properties. It's just, you're just not going to get access to that finance that you used to be able to get to in certainly the next decade or so. The other side of it, where I left I put my head on the pillow and I say, well, I've got, the properties that I've got, I'm looking at a target of around 160,000 passive income by the age of 50. So I think that I'm not being too greedy in terms of that's not $1 million a year. I'm not doing anything. And in regards to the accommodation that I'm providing for those people, if they look after my property, I'm very happy for them to stay in there. indefinitely. But I definitely get that. I mean, what's enough is probably the big question there. And for some people who decide to go big, like Arnie, they're on a different story, and it's probably not so much about the money for them. It's probably about the notoriety, probably about other things, the power, and that type of stuff. So I'd probably want to tap into their emotional intelligence as opposed to, their corporate agenda. In terms of what that looks like. But I think it's a brilliant question, and I think the next generation of Australians who are coming through are definitely more socially responsible. And I think there will be this shared community stuff that will start to take shape with the millennials, and I'm excited by what that presents for our society. And what we've always said, you really don't need more than 4, 5, maybe 6 really good ones.
And I think that's the point what Ben just said there, because we're looking to build 600 plans for clients this current financial year, and the majority of them don't need more than 5. And the challenge, I think, is when people have got 10 and 15, and then it squeezes other people out, which means they need to pay more, and then they can't get in, they need to be on the rent cycle. And I think that's probably, I'm making assumptions here, but that's not necessarily as socially responsible as self-funding retirement. And I hope that the Property Couch is playing its part in your question, because we are conservative. We want you to have 5 or less in most cases. We want you to retire out the debt. We want you to have reasonable opportunities to give back to the community. We want, you'll never see us. We actually don't enjoy helping people who want a Ferrari and a private jet. It's just not who we are. But it's people who want to spend more time with their kids or want to go over and give back in some way. So hopefully we're playing a part of that. But I've been doing this for 20 years, and there's plenty of strategies around, and most of the ones I was exposed to in the first 10 years was whoever dies with the most property wins. Hopefully the message that we're passing on is conservative, long-term, retire out the debt, have some passive income, be self-funded.
I think the first step for anyone who is seeking advice is not to be caught up in the hype, not to be caught up in what I did for this person over here. Number one, replace your income. That should be your first goal in terms of what income am I currently earning. My first milestone should be to focus on replacing that income. Quite frankly, if you came to us and you wanted to have $1 million a year, we're not your advisor. We simply, in our models, cannot do it. And we're not going to change the parameters and the variables inside our models. And we're not going to be teaching you how to be developers and all of these types of things. It just doesn't happen in our models. And now that you can't get access to the finance, it's also going to be very restrictive. So I think from that point of view, I love the question. I think anyone who's listening to take stock of that. That's why we spend a lot of time in the mindset space, and also in that sort of balance of what's fair and reasonable for everyone, and that's why I'll fight the good fight for the investor who wants to have an opportunity to invest and have a bit of negative gearing in the early stages, because ultimately they're going to be paying tax on that passive income. So I'll fight that good fight for them, but I'm not going to fight that good fight for them if they're arguing about their 15th, 20th, 30th or 40th property. I think there's a fairness test in that, and as the chair of the association, I've made my views very clear about what my agenda is, but obviously, that's a membership base. We all vote. If they all want, negative gearing to go to 30, 40, 50 properties, I'm just going to vote no to that.
All right, so we're coming very close to the end of the podcast. Thank you for that, Emma. So today, my life hack, Ben. Yes. Where are the iPhone users in the room? Hands up high. There we go.
Oh, jeez.
Have a look at that. Where are you, Stiggy? Where are the Samsung? All right,
yeah, there we go.
Hands up there. Okay.
There's some converts in the room.
I'm clearly an iPhone fan, but one of the things that you can do on the, for the iPhone users, when you flick the screen up from the bottom, there's the camera and the torch and all those sorts of things. You can actually put the record. There's a record button, so you can screen record like ScreenFlow or Camtasia. So you have to add it into the options. But so I'm looking at something on the phone and I want to show Ben the next day. What I do is I flick it up, I push record, I go through what I'm doing on the phone, I push stop, and it goes into my photos as a video. And then the next day I can do that. So where else is that usable? Or I'm researching So I'm, as well as being in property as part of the business, I'm also interested in a whole range of other things, including approaches that other property investors take. So I might be trawling through Facebook or Insta or whatever. I just push record. I can record what other people are doing, and it's a research tool for me as well. So Ben, that's my life hack today.
Love it.
For the iPhone users, flick up, record, go straight to the videos. You can email it to a friend. And for the Android users,
You haven't done your homework.
I haven't done my homework.
But I'm sure if it's available on iPhone, it's probably going to be available on the Android. All right, so did you know?
Oh,
We're up to did you know?
we are.
I'm organised.
And some prep.
A little bit of prep.
Yeah.
Okay, so I thought we're in Melbourne, and as a strong, passionate Melbourne boy, I'll give you some Melbourne facts that you may not necessarily know. So, Bryce, according to the PCA,
How's the speech therapy going?
Melbourne is officially the fox capital of the world. Okay, so but there is between 6 to 23 foxes per square kilometre in the urban city of Melbourne. It's pretty interesting, isn't
It's
it?
funny you say that. We saw one. Where was that too? The other day. I'm looking at my wife. We were driving and we were surprised that we saw the foxes. So.
Yeah. I saw a bit of roadkill fox on the way to the airport dropping off Max the other night.
Oh, great story.
So there you go. Well, it's true. That one's obviously bringing the numbers down.
Bringing your best.
Melbourne was originally going to be named Batmania. No jokes.
True, we got Batman.
No
Ave.
jokes.
Yeah, it was the,
after one of its founding fathers, John Batman.
My son would be stoked with
Batmania.
that, wouldn't he? Jack would be. That'd be.
I reckon the
wonderful.
Avengers would have, taken Dockland Stadium pretty quick if that had been the case. We might have.
He
even
attacked my Spotify yesterday. I had this nice little writing playlist. I'm trying to finish off the book, and every second song Batman kicked in, so we queued him up on Spotify.
All right, a couple more before we close out today. Fisherman's Bend in Port Melbourne is the only place in the world where we make Vegemite. And we make 22 million jars sold every year. It's pretty interesting, isn't it? A couple of other nice ones. The Ute, the famous Ute, a utility vehicle with a cargo tray, was invented and built by Melburnian James Freeland Laycock in 1929. So the Ute came from Melbourne. Another fascinating thing, Melburnian Dr. David Warren of the Aeronautical Research Centre invented the black box. The black box that goes into every plane around the world. He invented that in 1958 and it's now used obviously everywhere. And this came after the death of his father in a plane crash. So thank you for doing that to find out what's going on. A couple of other interesting ones. The electrical drill was first patented by an engineer by the name of Arthur James Arnott, and he patented the first electric drill. So that was interesting out of Melbourne. And Henry Sutton, invented the television. Now, a lot of people don't realise that, but he lived in Ballarat and he had a little telephone business up there, and he sent some pictures, some very primitive pictures, via the telephone to people in Ballarat to watch the Melbourne Cup back in 1885. Very clever man. And in fact, he met Alexander Graham Bell, and he had this idea that Graham Bell did, which was he had this idea of have the phone box on the wall, but if you could have a wire and a speaker in that wire, you could have a handset. And that's exactly what he did.
Mate, you're bringing your best tonight. I'm very, very impressed. Now, hands up those people in the room who are not past episode 100 yet.
A couple of newbies, that's good.
You're confused with the Did You Know segment, aren't you? You're waiting for the international sign-off. Who wants the international sign-off to come back?
No,
hey,
not happening.
A few of you. It was all had a little French accent, didn't they?
Countries.
Yeah,
I think I've done that, haven't I?
We've got a few. So, all right, Ben. Well, that's it.
That's it.
Time flies. So the podcast is well and truly over. But thanks everyone for your questions. We appreciate that. And mate, until next week.
Knowledge is empowering, but only if you act on it.
See you later.